Okay. It's that time of the month. Pause. Mayday payday. We're going to be talking about the stocks going ex-div in May. As obviously mentioned in that last video, we're going to make this a monthly series because you guys hit that 200 likes, or you guys smashed it in fact. And so in this video, I'm going to talk about the stocks that are going ex-div in May, the ones that have declared and the ones that have still yet to be declared. And for the ones that have declared, so guaranteed they'll be going ex-div in May, and guaranteed you'll be getting a dividend payment in either May or June, I will be giving you the pros and cons that I feel are relevant for those stocks. So yeah, if you want to know all of that plus more, like, comment, subscribe, help the channel get to 6K subscribers, and we can get the world of investing, dividend investing, out to more people. But if you guys want the same thing for June, I need to see 300 likes. So please like the video. If I get 300 likes, then we will just keep this series going on a monthly basis. But let's get into it. So the stocks I'm going to talk about today very briefly are Admiral Group, BP, Polymetal International, Sage Group, Glaxosmithkline, Royal Dutch Shell, Unilever, Imperial Brands, Intertech, Morrison's, Tesco, Prudential, and DCC PLC. For those of you that are new to this series, these are all stocks in the FTSE 100. So these are all Britain's largest, most safest stocks in the market. We're not at the moment doing small cap stocks or AIM stocks or anything of that nature. These are large, very safe companies that are obviously paying dividends, and you know, we want to shine a light on them and give you some information that can help you maybe trigger some of the stocks that you might want to pick. But I must preface the rest of this video with always do your own research. I'm going to obviously give you some information, you know, things that might be important to me, but all of you guys are going to have, you know, the own fundamentals or metrics or insight or information that's going to be important to you. So definitely always do your own research before investing your capital. But enough preamble, let's get straight into it. So the first one we're going to talk about is Admiral Group. So Admiral Group, you guys know, is an insurance company, and they're going ex-div on the 7th of May, so next week, and the payment is destined for the 1st of June. Their annual yield at the moment is 6%, which is a pretty decent annual yield in this current climate. And in terms of their pros and cons, the first pro for me is that their track record previously, if you look at the last 1, 3, 5 years, has been pretty decent. They seem to be a pretty safe and sturdy company from that perspective, and have been growing, which sometimes you find with some of these bigger organizations, they actually shrink in valuation, but because they're so large anyway, people don't really notice that the business is actually a shrinking business just because, you know, they're in the mega cap stage. But it's good to see that Admiral has been growing year on year for the past 5 years, which I think is quite important and might be testament to how they run and what might be happening in the future. They've got a really good payout ratio. I think it's about 60%. So I think the sweet spot we know is 35 to 55%, but we know they're not paying all of their earnings out. They are obviously retaining some of their earnings. So, you know, if they do rise their dividends, you can see that they'll have the ability to do so. And there's been a lot of insider buying activity, which has been good as well. So overall, there's been some really good positives with Admiral, which would make them a pretty safe investment. But some of the cons to bear in mind is that the future growth outlook from an analyst perspective is actually that they're going to be shrinking over the next 1 to 3 years by 2%. So that is something to be mindful of. It might be corona linked, it might not be corona linked. You know, with a lot of these insurance companies, there might be a lot more claims in different verticals of their business. So you can see that could potentially be possible. So that's something to potentially watch out for. Maybe they're not going to have such a good performance this year or next year. If that's the case, they've also got a rise in debt to equity ratio. So debt to equity ratio, for those of you that don't know, is the amount of debt versus the amount of equity that a company has. Pretty simple. And you want to see a lower debt to equity ratio. It means they've got obviously a lot more capital, a lot more assets that they can do, and they're a bit more of a safer company. But at least if they have got debt, you want to see it kind of falling ideally. With Admiral, you're seeing it rise. So actually, they're getting a lot more debt versus the equity that they have at their disposal, which I think is a little bit of a cause for concern. Doesn't mean that it's necessarily a bad thing overall, because obviously it is a large cap stock, but it's definitely something to be mindful of. The next one is BP. You guys know what BP is, obviously, the oil and gas company. 7th of May as well is their ex-dividend date, and they'll be paying on the 19th of June. Their current yield is 10.48%, and that's pretty a testament to what's been going on with the whole oil crash recently. So obviously we know that there's been a significant oil crash. Oil has dropped down to zero. In fact, they're trying to offload oil to people, and there's not enough storage space for it. And you know, BP and a lot of other oil companies has dropped. I've seen, you know, some of the fewer smaller oil companies, like I think Apache or Cairn Energy or a few others that I've been monitoring on my watch list, has been rising this week and last week, which has actually been significant. But yeah, the situation with BP from a pros and cons standpoint is that the future growth is considered to be about 37%, which is quite high, and I think that's testament to the fact that BP's dropped so much. So this might be a good time, a bit of an opportune time to potentially get into it. However, some of the cons for BP is that it's what I consider a dividend trap, and what a dividend trap is to me is that irrespective of the amount of dividends you earn or the percentage of dividends you earn with a specific stock, because the capital gain is eroding on a year-by-year basis, when you do eventually go to sell the stock, you will always be selling at a loss. Now obviously it can depend on how long you hold the stock for and whether you average down and all of those other investment strategies, absolutely. However, if you was just to say invest on this day in 2013, sell on this day in 2018, and just collect the dividends, then by 2018 you would actually have less money than you would have just leaving it in a current account effectively, because your money would have been eroding from a capital gain standpoint. So I think that's something to be mindful of. Just because you are getting the dividends, it doesn't mean that you shouldn't take a look at the capital gain appreciation, because you don't want your money to be going out in one end when it's coming in on the other end, pause, and you know, obviously you're not really making no money from that standpoint. The other thing as well is the return on equity is about 10.6%, and it's forecasted to basically maintain at that level. Now return on equity is another one of those metrics, such as, you know, price to earnings, price to book, price to sales, all of the different ratios that you might use in order to comparatively analyze one stock or one company with another stock. Now return on equity is quite simple. It's basically the net income, so profit, divided by the equity, and we know that equity is assets minus liability. So effectively what we're trying to understand with return on equity is basically the return on the net assets that's available within a company. Now a lot of people say that the sweet spot, or the higher the better, but you know, you should be looking for about a 15 to 20%. So you know, you don't need to know the calculations, but as long as you know the numbers to look out for, that's what this channel is here to help you do. So you know, with say PEG ratio, you want to be looking at 1 or less. With return on equity, you want to be looking at 15 to 20%. So obviously it being 10% is quite low, and what that's basically saying is that, you know, you're not going to get a good enough return on the amount of equity it's got available, and potentially your money could be better elsewhere in another company, maybe in the same industry or maybe in a different industry. So it's worth basically looking at that and seeing, will my money be working hard enough for me in this specific stock? Obviously we can't all forecast or predict the future. These are forecasts. It doesn't mean that it's necessarily going to be the case, but it's just another data point to potentially look at with BP. Now next one is Polymetal International. This is a mining company. I think they mine gold in many areas of the world, from Russia to Asia to, you know, different parts of Africa, I believe, as well. Again, 7th of May is the ex-dividend date. They'll actually be paying their dividend in May, and that'll be the 29th of May, and their current yield will be 2.98% annually. Now the pros for Polymetal is their track record is absolutely outstanding. If you look at their 1, 3, 5 year history, you're seeing it in triple digits. In fact, I think it's about 200 and something odd % with dividends in the last 5 years. So it's been a great resource in terms of, you know, generating capital and generating returns for investments. And also another pro is that the future growth is also expected to be good as well. So that's a really big positive. The return on equity was pretty high as well. I think it was around the 35% mark. I do need to double check, so don't quote me on that, but last time I checked it was pretty high. high. So unlike BP being 10%, this is at much more of the higher end. I think it might have even been in the 40% actually. I'm gonna venture to actually say that, but you know, do your own research just in case. But it's obviously good from that standpoint. However, some of the potential cons with Polymetal is that at the moment the valuation is seemingly to be quite high. So it's at the upper end of analyst expectations. It's at the upper end for price to earnings versus its industry, and so potentially, you know, if you are buying it now, you potentially are buying it at one of the higher valuations or the higher prices. Doesn't mean that it's not going to continue to grow, but it's just something to potentially be mindful of. Another thing is that there is a high level of debt as well with Polymetal, and it does seem to be slightly growing as well. So again, that's just something to be mindful of. Now, Sage Group, 7th of May and the 12th of June is the forecasted EX-Div and the forecasted payment date. However, they haven't declared it, so it isn't guaranteed that Sage Group will be paying. I will continue to monitor the situation, but at this current moment, as of this second, Sage Group hasn't guaranteed that they're going to be paying their next dividend. So that's something to monitor if you are a holder of that stock or if you are interested into it. The next one is Gsk Glaxosmithkline. That's obviously a pharmaceuticals company. Their EX-Div is 14th of May, so you've got a pretty decent amount of time to get into that stock if you wanted to. However, the payment day will be the 9th of July, so you know, you'll be waiting some time to actually get that payment. Now, the annual yield is 4.74%. Really like GlaxoSmithKline. They've got a good record. They just seem to be a really safe company and a safe organization. The only con that I could potentially see with GlaxoSmithKline is just the debt situation again. Now, listen, debt isn't necessarily a bad thing. It's all about how you manage your debt. Let's say you take out a 20k loan just to buy your BMW. You know, people say it's a bad thing. I personally wouldn't do that. That's just me, but you know, everyone's different, right? However, if you are paying say £200 a month on your payments, but you earn £3,000 a month, then you can comfortably manage that debt, then actually it's not necessarily a bad thing. It's all on a case-by-case basis. Me personally, with the stocks, I've got lots of stocks that are in debt, particularly some of my growth stocks. I used to be so against debt with stocks in the early days, and actually a lot of the stocks that does have debt tend to sometimes have a better return. So high debt doesn't necessarily mean it's a bad stock or it's going to be a bad return. It's just something that I think is a con, and it always gives me a little bit of, it unnerves me a little bit sometimes. So it's something that I would put in the con column. But by all means, it's not necessarily a reason to not invest into that organization. Now, Royal Dutch Shell, another oil and gas company, 14th of May is the expected ex-dividend date, and the 22nd of June is the expected payment date. But again, they have not declared their dividend, so it's not guaranteed that they will be paying their next dividend. So we shall move on. Unilever, which is obviously a utilities company. They're going ex-div on the 14th of May, which is guaranteed, and their payment date will be on the 4th of June. Now, their dividend yield annually is 3.63%. One thing I like about Unilever is they've got a good profit margin. I think it's around the 20% mark. So, you know, they're safely making profit. They're safely making earnings on every share on an EPS basis, and that's something that, you know, you want to see for a stock that you're going to hold continuously, get those dividends and continuously reinvest. So that is definitely a positive sign and something to be happy about. However, some of the cons with Unilever specifically is that they've got rising debt again, which I think is for me a bit of a cause for concern. They've also had a bad 1 year return, so their last year return has not been so good. Now, why is that a problem? Obviously, past performance isn't always a true indicator of future performance, but when, say, the 3 and 5 year has been okay, but then the last year has been bad, and then particularly with what's going on with this current situation that we're all, you know, living with at the moment, it might be a sign that there could be some, you know, more negative situations that come, particularly if the debt is also rising as well. So it might be that actually the next couple of years they actually don't turn a profit from a capital gain perspective, and they actually recede in their valuations. But that's something to potentially look at. Imperial Brands, which is a stock that you guys know I hold, 21st of May is their expected ex-div, 30th of June is their expected payment date. I expect this to pay. They've even announced on multiple occasions that coronavirus hasn't really affected their business, so I expect it to be declared, but at this current juncture it hasn't been declared, so we will move on. Intertech, which is a support services company, 21st of May is when they go ex-div, and on 11th of June is when they pay a 2.19% dividend yield annually. Now, One thing I really like about Intertek is they've got a stable track record, stable 10 years of dividend, and it's been rising as well. They've got a really good payout ratio, which I think was about 50% mark. So it just sits within, you know, a nice amount where they've got enough earnings to retain in the business, but they're enough money to reward out to shareholders as well. However, one other thing to consider, as you know, me personally as a con, is that, you know, they're in the software services industry, they're in the kind of IT industry, and IT is a very growth related industry. And one thing about Intertek is that they are underperforming their industry. So actually your money could potentially work harder, dividends or no dividends, in multiple other IT related stocks. So from that standpoint, I feel that, you know, although they're stable from a dividend standpoint and it is rising, you could potentially earn more by looking at another opportunity within the same sector. Also, they're a bit overvalued as well. So similar to Polymetal, they're at the higher end of their valuation. So it's something to be mindful of, that, you know, maybe if they're at the 52-week high mark, I didn't even check if they're at the 52 high mark. I think they've obviously dropped a little bit, but their valuation of their business is a little bit high, then actually maybe you might see the share price fall a little bit going forward. The next one is Morrisons. Obviously we know what Morrisons is. 21st of May they'll be going ex-div, and they'll be paying on the 29th of June. Their annual yield is 4.64%, which I think is a good yield. They're good value. I think they're good value, and one thing that's really good to see is that their debt is falling, particularly obviously with this, you know, coronavirus situation. I think retailers, particularly supermarkets, have benefited from this current situation. They're one of the few types of businesses that have benefited, you know, online retailers, offline retailers, either or. They're seeing their stores and their shelves, you know, their stores flooded and their shelves empty, which is obviously a good thing for them from a revenue and an earnings standpoint. So you can probably expect that Morrisons might have a pretty good year just from, you know, this first quarter alone. So that could be, you know, a bit of a momentum to potentially rise. However, from a con standpoint, 3 years onwards, they haven't been doing well. 3 years, 5 years, their past performance. But again, it's not always a true indicator for future performance. It's just something that I like to look at. And in terms of their growth, so when we're talking growth here, we're talking their earnings growth continuously over the next future years. Is actually forecast to be flat, really. So it's about 0.2%, and that's going to maintain like that for the next 1 to 3 years. So it doesn't seem like a business that's going to really grow. Now, a lot of these businesses, because they are significant sizes anyway, they don't necessarily grow that large just because they are already big. So, you know, they are more, you want to see it stable for dividends anyway. But that's just something to bear in mind. The next one, Tesco, every little helps. 21st of May 2020, the 3rd of July is when they'll pay, and that's been declared as well. So again, another guaranteed dividend. The annual yield is 3.89%, which is pretty decent as well. One thing I like about Tesco is their earnings per share forecast going forward is actually quite high. So obviously they are expected to turn around bigger profits over the next years to come as well. And their debt is falling as well, which is another good sign. And again, just like the Morrison situation, I would imagine that when they come out with their next earnings update, due to the current situation, they probably would have done pretty well. And that might be a good momentum boost going forward into the future. However, some of the cons is their return on equity, similar to the return on equity for BP, is quite low. It's about the 10% mark as well. So again, you know, could your money be better placed in another organization? That's something to think about. And in terms of their growth as well, at the current moment, you know, their growth has been much lower than the UK market across all sectors. So what that basically means to me is that you could have put your money into pretty much 90% of the other FTSE 100 stocks and made more previously. Obviously, you know, can't predict the future, but previously, and that for me is quite important, and that for me is something to consider. One of my things in my 2020 vision in terms of my criteria is that, particularly when I'm picking a growth stock, I want a growth stock that is outperforming its industry. So if the industry average is 20%, I want to pick a growth stock that's 25% up, 30%, 40% up. I want to pick one of the higher performing ones within the industry rather than lower performing ones. You can also then look at the market as a whole. So say the UK market, I want a stock that is doing one of the best performances within that market and expected to continue doing so in at least a short term for some of the growth stocks. If it's underperforming, you know, the rest of the UK, or underperforming the whole supermarket industry, Me personally, I have a finite amount of capital to deploy into the market, so obviously I want to put it somewhere that's going to work a little bit harder for me. Again, that's just me personally. You guys might like Tesco because, you know, they do, I don't know, good tropical juice or whatever. Who knows why you like Tesco? But ultimately, you know, that's some of the things that I potentially look for. Now the next one is Prudential, insurance company, but they obviously do a lot of stuff in the kind of insurance, asset management, investment space. 22nd of May guaranteed dividend. 18th of June is when they'll pay 3.38%, which is good. One of the pros is that they've got quite a low PEG ratio, so it's under 1. That's price earnings in relation to growth. So as I mentioned earlier in this video, you want to see it at 1 or below, which is good. And this is also a comparable metric across industries, which is quite important, and one metric that I like. If you want to know more, go to the fundamental series. I'll leave the link in the description, and you know, you can learn more a bit about that. So yeah, that's a really good thing, and that shows that actually there's a little bit of growth potential within the Pru. However, again, I think it's a bit of a dividend trap. If you look at the previous performance for the last 5 years, they've again had a negative return to shareholders. So irrespective of the dividends that you've earned, you know, you've had a bit of a negative return, which is just something for me personally that I don't really like. And like you guys already know, I'm not primarily a dividend investor. I probably have, you know, slightly more dividend stocks to growth stocks, probably by 60-40, but you know, with the recent Shopify and AMD rise, that might be now a bit closer to 50-50, but I do probably have, you know, a bit more in the dividends space, but I am trying to transition to a bit more growth. I'm still hybrid, as you guys know already, and so for me personally, I just can't put money into a stock and get, you know, 2 payments a year, but for the rest of the 12 months I see my stocks continuously fall down. For me, it's just not what I'm personally interested in, but you know, to each his own. Again, they have a high debt to equity ratio as well, so equity falling, debt rising, that for me is obviously a bit of a negative sign. The last one, DCC, they have not announced if they'll be paying their dividend, but you know what, their ex-div is expected to be 20th of May, so there's still a bit of time for that to be announced, and if they do announce it, then it's forecasted the payment date will be the 17th of July, so you know, more updates on that. But yeah, hopefully you found this video useful. If you did, like, comment, subscribe. I really want to get 300 likes, and then I will do, you know, next month I will do it for June, and we'll just continue this series going forward. I am still looking at how we can do this for AIM stocks, how we can do this for FTSE 250, how we can do this for American stocks. Obviously, you know, there is more work and more time to be done. Probably we'll do separate videos for those types of things as well, and make those a monthly series. But yeah, if the demand's out there, then you know, I'm here for you guys, and I'll definitely continue to produce that. But listen, hopefully you found this video useful. Like, comment, subscribe, share with anyone that you think might like it, and I will catch you next time with another investment video. Take care, guys. Peace.